Welcome to The Explainer. So glad you're here, because we've got a seriously fascinating puzzle on our hands today. We're unpacking the, honestly, pretty paradoxical valuation of Northwest Bank shares, ticker symbol NWBI. Looking at their Q1 2026 data, the signals are just literally pointing in completely opposite directions. Are we looking at a hidden gem trading at a massive discount, or is it an overvalued regional bank masking some deep structural risks? We're going to decode this mystery using exactly what the bank and analysts are reporting, just to cut right through the noise.
Okay, here's our roadmap for today. We'll hit the NWBI valuation mystery, Q1 earnings and efficiency, intrinsic value versus PE, interest rate sensitivity risks, credit quality and macro threats, and finally, weighing the complete picture.
Section 1. The NWBI valuation mystery.
Right, so this is the ultimate question we're trying to answer. When analysts, and automated models for that matter, look at Northwest Bank shares, they are getting wildly conflicting outputs. Like, how is it possible that one set of financial metrics just screams, hey, this stock is a bargain, while another set looking at the exact same company suggests it's way overpriced compared to its peers? It's your classic tug-of-war between future projections and current realities.
To ground us a bit, let's look at the bank's recent performance. What's super compelling here is the momentum. Over a recent 90-day stretch, the share price returned over 12.5%. That short-term sprint is actually way stronger than its longer-term pace, especially considering its total 5-year shareholder return sits around 32.5%. This recent spike? Yeah, it tells us the market is definitely reacting to something new.
Moving on to Section 2, Q1 earnings and efficiency.
So the specific wins from the Q1 2026 earnings report really gave the market a much clearer, way more positive view of management's current outlook. They posted a totally solid GAAP net income of $51 million, which translates to 34 cents in earnings per share. But the real anchor here? That's the new 2026 revenue guidance, projecting somewhere between $710 million and $730 million. Putting firm guidance like that on the table just removes a ton of uncertainty for investors. It really forms the baseline for the whole bullish case. And there's a massive operational improvement driving this outlook. Let's think about the cost-to-income ratio. Over the trailing 12 months, that ratio sat at a somewhat bloated 66.64%. But in Q1 2026, it dropped dramatically to 57.82%. Honestly, in the banking world, that is a major efficiency gain. It essentially signals the bank is getting significantly better at controlling its expenses relative to the revenue it actually brings in.
Management's own commentary illustrates exactly where that efficiency is coming from. They noted that cost savings from the Penns Woods acquisition are actually tracking way ahead of original expectations. This perfectly supports the narrative that the bank's digital transformation, plus those acquisition synergies, are finally moving past the messy transition phase and just flowing straight to the bottom line.
Section 3. Intrinsic value versus PE. All right, let's look at the bearish side first. Based on the price-to-earnings, or PE ratio, investors are paying a clear premium for NWBI. They're trading at a PE of 15.6. Compare that to their direct regional banking peers at 13.4 and the broader U.S. banks industry sitting way down at 11.5. If you only looked at this one metric, you'd probably conclude Northwest Bank shares is just downright expensive. You're paying more for every dollar of their earnings than you would for an average competitor.
And this brilliantly illustrates our whole paradox, because while the PE ratio says it's expensive, one intrinsic valuation model, specifically a discounted cash flow or DCF fair value estimate, prices the bank at a massive $26.46 per share. Compare that $26 figure to its actual share price, which has been hovering around $13 to $14. If you believe the DCF model, the stock isn't expensive at all. It's practically trading at a 50% discount.
So the absolutely crucial point here is weighing this massive modeled fair value against the harsh reality that investors are already paying above-average multiples for today's earnings. The bullish narrative relies really heavily on future earnings growth materializing to justify that discount. But the bearish view? It says, hey, you're already paying a premium multiple. The good news is already priced in.
Moving to Section 4, Interest Rate Sensitivity Risks.
To really understand these risks, we need to quickly clarify a little bit of jargon. You'll see the term basis points, or BPS for short. It's really just a financial unit of measure, where 100 basis points equals a 1% change in interest rates. Okay, got it? Now let's see how rate changes actually affect Northwest Bank shares.
The banks on SEC 10K filings simulate when an upward shift in interest rates over a 12-month period actually means for their net interest income, which is essentially the core profit they make from lending. If rates go up by 100 basis points, their net interest income is projected to drop by 1.2%. If rates spike by 300 basis points, income drops by 4.8%. This tells us pretty clearly that right now, a rising rate environment acts as a significant headwind for their core profitability.
But here is the most surprising fact. Downward rate shifts also project a decrease in net interest income. Yeah, their modeling shows that even if rates drop by 100 basis points, net interest income still shrinks slightly, by 0.5%. That's fascinating, right? Because of the specific mix of loans and deposits they hold right now, the bank is actually sensitive on both ends. Whether rates go up or down, their immediate 12-month net interest income takes a hit.
Section 5. Credit quality and macro threats.
Analysts are watching specific areas in the bank's loan portfolio really closely, because these could worsen and honestly knock that whole future earnings narrative completely off course. The key headwinds include pressure from higher non-performing loans, specific vulnerabilities in commercial real estate, and creeping credit issues related to multifamily construction and certain commercial borrowers. Make no mistake, if these sectors experience a downturn, those projected future earnings we talked about earlier, they'll evaporate fast. To put a real dollar amount on that risk, the bank ran a hypothetical stress test. They disclosed that if they faced a 100% downside macroeconomic scenario, so essentially if the economy hits a severe rough patch, their quantitative allowance for credit losses would need to increase by a staggering $89 million. That's $89 million that would have to be set aside just to cover bad loans. That would obviously take a massive bite right out of their bottom line profitability.
Finally, Section 6. Weighing the complete picture.
All right, let's pull all this together. On the reward side, you've got a forecasted earnings growth of nearly 24% per year, driven by those excellent efficiency gains we saw, plus a very juicy dividend yield sitting right around 5.65%. That is highly attractive. But on the risk side, you're paying a premium PE multiple right out of the gate compared to peers, and the bank is facing demonstrable interest rate sensitivities alongside some looming macroeconomic credit threats in commercial real estate.
And that leaves us with this final provocative question. Which signal carries more weight for you? Do you trust the discounted cash flow models that say the efficiency gains will propel this bank to a $26 fair value? Or do the premium pure pricing and that huge $89 million downside risk keep you safely on the sidelines? Finding your own margin of safety really means deciding which of these financial signals you actually believe more. Thanks so much for joining me on this explainer, and I really hope this gives you the exact tools you need to dig deeper into your own analysis.